Canada IFRS 9, Financial Instruments, the complete CPA Prep Masterclass. Hello and welcome to CandiMentor. Today we decode Canada IFRS 9, Financial Instruments, as applied under Canadian GAAP for publicly accountable enterprises and guided by CPA Canada's handbook. Canada follows full IFRS 9, but the Canadian financial landscape gives it a unique flavor. Major banks, mortgage lending, credit unions, mining and energy exposures, rate-sensitive households, and strong regulator expectations from OSFI. Before we dive in, hit subscribe to CandiMentor. Sign. What Canada IFRS 9 is. The Canadian context. Canada applies IFRS 9 exactly as published by the IASB. The Canadian financial ecosystem affects interpretation. A heavily regulated banking sector under OSFI, mortgage and housing loan portfolios, commodity exposure in oil, gas, and mining, a strong pension fund culture, credit unions, and heavy derivatives use for interest rate and currency hedging. Interview-ready anchor line. Canada uses full IFRS 9, but the ECL model and classification choices reflect Canada's credit, housing, and resource-driven environment. The three pillars of IFRS 9, CPA Prep Core, speak these clearly. Every CPA interviewer expects them. 1. Classification and measurement. 2. Expected credit loss impairment model. 3. Hedge accounting aligned with risk management. These three pillars drive exam and interview questions. Classification, business model, and SPPI test. Financial assets are classified based on two tests. Test 1, business model, hold to collect and sell, trading, or fair value management. Test 2, SPPI test, do cash flows represent solely payments of principal and interest? Classification outcomes, amortized cost, FVOCI, or FVTPL. Canadian examples, banks hold mortgage loans at amortized cost. Pension funds and insurers use FVOCI for debt. Energy firms hold commodity-linked instruments at FVTPL. Indigenous and regional institutions typically use amortized cost unless product features fail SPPI. SPPI, Canadian hotspots. SPPI permits only basic interest-style cash flows. Watch for red flags. Commodity indices, equity-linked payoffs, contingent payments and resource contracts, prepayment options with unusual compensation, and complex mortgage features. If SPPI fails, classify the asset at FVTPL, even if business model suggests amortized cost. This is a highly tested topic in CPA case studies. /URL. Amortized cost. The core model. Most Canadian loans, mortgages, auto loans, credit cards, commercial lending are measured at amortized cost. Use the effective interest rate to spread interest income across the life of the instrument. Include fees, transaction costs, premiums, and discounts in the EIR. Journal pattern. Initial recognition, debit loan receivable, credit cash. Interest accruals then follow the EIR. FVO Canadian Pension and Insurance Usage Debt at FVO Canadian Pension and Insurance Usage applies to instruments held to collect and to sell. Unrealized gains go to OCI and realized gains recycle to profit or loss. Very common for pension funds, life insurers, and institutional investors. Equity at FVO Canadian is an irrevocable election at initial recognition, and gains remain in OCI permanently. Stop. FVTPL, volatility and trading. FVTPL is the residual category for trading books, derivatives, structured products, crypto holdings, and instruments failing SPPI. Expect P&L volatility and align treasury and risk explanations accordingly. Mining and resource sectors often trigger FVTPL classification through embedded features. End. Expected credit loss. Central to Canadian IFRS 9. IFRS 9's ECL model is forward-looking and probability-weighted. ECL equals PD times LGD times EAD. Use the three-stage approach. Stage 1, 12-month ECL for performing assets. Stage 2, lifetime ECL where credit risk has increased significantly. Stage 3, lifetime ECL for credit-impaired assets with interest on the net carrying amount. Canadian banks use sophisticated PD and LGD models. Exam answers must show understanding of data inputs, cash flow mechanics, and scenario weighting. So, SICR, Canada's most tested judgment. Significant increase in credit risk relies on indicators such as days past due, commonly 30 days, credit score deterioration, unemployment and housing trends, household debt ratios, province-specific exposures like Alberta oil risk, and rate sensitivity from Bank of Canada cycles. Use a mix of quantitative thresholds and qualitative overlays, and document the governance behind them. Forward-looking information. Canadian macroeconomic variables include probability-weighted macro scenarios, GDP growth, unemployment, inflation, Bank of Canada rate paths, housing price indices, oil and commodity forecasts, and exchange rate risk. Large Canadian banks publish scenario weightings. Use at least 3 scenarios and show how weights move ECL materially. End. ECL numerical example. CPA prep level loan. CAD $10,000, PD 3%, LGD 40%, EAD CAD 10,000 equals 0.03 times 0.40 times 10,000 equals CAD 120. Journal. Debit impairment expense CAD 120. Credit loss allowance CAD 120. Use short calculations like this in oral responses. Loss allowance accounting flow. Initial recognition, debit loan receivable, credit cash. ECL recognition, debit impairment expense, credit loss allowance. Write-off on default, debit loss allowance, credit loan receivable. Recoveries, debit cash, credit recovery income. Clear flows are essential for exams and interviews. Modifications. Restructurings common in Canada. Mortgage renegotiations, covenant waivers, and commercial loan restructurings are frequent. If modification is substantial, derecognize the original asset and recognize a new one. If non-substantial, adjust the carrying amount and recognize any resulting gain or loss. Be ready to explain the commercial rationale and model adjustments. Derecognition, when assets leave the books. Derecognize when contractual rights expire or risks and rewards transfer. Common Canadian events: mortgage securitization, sale of NPL portfolios, factoring and supply chain finance. Evaluate whether risks and rewards have transferred and document the conclusion. Financial liabilities, mostly amortized cost. Financial liabilities are typically at amortized cost unless designated at FVTPL. Canadian contexts include commodity-linked debt and convertible debentures. Own credit risk changes for liabilities designated at FVTPL are presented in OCI. Derivatives and embedded derivatives. Canadian essentials derivatives used heavily in Canada include interest rate swaps, FX forwards, commodity hedges for oil and gas, electricity and natural gas contracts, and equity-linked structured notes. Separate embedded derivatives when host contracts are not closely related, common in resource sector contracts. Hedge accounting. Align with risk management. Hedge types: fair value, cash flow, and net investment hedges. Canadian use cases: hedging USD revenue from mining firms, hedging floating rate debt, hedging electricity price risk. When effective, the accounting aligns with economics and moves effective portions of gains and losses to OCI for cash flow hedges. Hedge accounting example: clean narration. Derivative gain, CAD 25,000, and hedge is highly effective. Journal: debit derivative asset, credit OCI, cash flow hedge reserve. When the hedge sale occurs, debit OCI, credit revenue, or adjust cost basis. Practice this flow for interviews. Disclosures. What Canadian regulators expect. Detailed IFRS 7 and IFRS 13 disclosures are required. Credit risk exposures. Staging roll forwards. Macro overlays and sensitivity analysis. Fair value hierarchy details. Derivative positions and hedge relationships. Maturity and liquidity schedules. Canadian banks often provide robust disclosure sets. Study their tables for exam examples. Canadian industry scenarios. Use these in interviews. Banks, mortgages, credit card ECL, auto loans, staging and overlays. Oil, gas, and mining. Commodity-linked derivatives. FX exposure. Receivable credit risk from global buyers. Retail and credit unions. Store cards. Regional economic sensitivity. Consumer loan modifications. Manufacturing and exporters. Hedging USD sales and embedded derivatives in supply contracts. Pensions and insurers. FVOCI portfolios. Hedging for guarantees. Pick one to illustrate classification, ECI impact, and hedging choices. End quote. Journal entries. Full debit, credit narration. Loan origination. Full debit, loan receivable. Credit cash. ECL loss. Full debit, impairment expense. Credit loss allowance. Interest income. Full debit, cash. Credit interest income. Hedge accounting. Full debit, derivative asset. Credit OCI. Derecognition write-off. Full debit, loss allowance. Full debit, impairment loss. Credit, loan receivable. Memorize these flows for quick recall. Practical interview tips. CPA Canada style. Start with classification logic. Then explain SPPI simply. Move to the three-stage ECL model with a short numeric example. Mention overlays and governance. Explain hedge accounting without heavy jargon and tie answers to Canadian industries. Use short, clear sentences for TTS delivery. That's it. Call this audio as voice intended. Use MP3 preview. Final wrap. Canada IFRS 9 is global IFRS 9 applied in a system dominated by mortgages, commodities, regulated banks, and sophisticated hedging. Anchor answers in classification, ECL modeling, and hedge mechanics. Add Canadian examples for credibility. Speak slowly, clearly, and logically to demonstrate mastery in CPA interviews. If you learned something today, subscribe to CandiMentor. We're building the world's best learning hub for accounting, finance, and professional practice, and you should be part of it.